A warm welcome to all our clients to this first webinar of 2021. It's an absolute pleasure for me and my team to spend this afternoon with you and share our performance and our views on the world in this webinar. Again, thank you very much for joining us. Grab a glass of wine. It's legal now, and enjoy the presentation. Thank you. So, Arthur, over to you.
Thank you, Carl. Good afternoon, everyone. I'm going to share some slides here with you today. You know, it's not often that we get to talk about bright spots in the South African economy. So there are some bright spots, and we're going to take the opportunity to do that today. But of course, we also can't lose sight of the risks, and those latent risks are still very significant, and they do relate mainly to fiscal policy. So clearly, we'll need to touch on that as well. But firstly, let's look at those bright spots and things that are going right for us at the moment. So the first one is the receding level of COVID-19 infections. This chart shows you the daily infections per million people in South Africa. And if you take the last couple of days' data and add it to this, you're going to find that we're getting close down to the levels that we were when we kickstarted the economy in the third quarter of last year after the first wave. So with easing of restrictions, I think it's reasonable to look forward to a bounce back in the economy from the second quarter. First quarter data, probably not going to look good. And also just the more recent data releases that we have for late last year show that there was already a momentum fading. For example, restaurants, we know their income was down 51% year on year in November. If we look at the December data for airline passengers, that was still only 43% of the level of a year earlier. The business activity from the production side of the economy, index in the PMI, declined to well below 50. So the production side of the economy is slipping, and we know services activity clearly also not where we would like it to be. So first quarter data, not going to look particularly good, but from the second quarter, I would expect improvement to come through again. But I think the key reason to be confident about that improvement in the second quarter of the year, there are a few of them. Firstly, you know, one positive that we do have is a very long-term decline in inflation in the economy, disinflation. And that means that the Reserve Bank can remain relaxed for a while. I know that the quarterly projection model of the bank shows a 25 basis point interest rate hike in the second quarter and another one in the third quarter. But I think against this economic backdrop with this level of unemployment, I think that the Reserve Bank can look through that for a while, keep interest rates low for an extended period before deciding to change them. So the black line on this chart shows the GDP deflator, which is a measure of core inflation, and you can see the long sustained downtrend there. The dotted red perpendicular line is when we introduced inflation targeting. But of course, then the one thing that's very negative about the South African economy is the long-term decline in potential growth. That's the blue line there. These lines just detrend the data, so they take away all the noise and show you the true underlying trend. And quite clearly, that's moving in the wrong direction. And it's been moving in the wrong direction since 2007 when we introduced the developmental state idea. And we've had a decade of increasing government spending to GDP. We're at the point now where that is absorbing a lot of savings from the economy. The multiplier effect of an additional rand of spending is in fact negative now. About a decade ago, it was significantly positive. For every rand, you would get more than a rand back into the economy. But now each rand being spent by government, the Reserve Bank calculated recently, has actually got a negative impact on income. So, but relative to that, even though we've got this declining trend in GDP in real terms, we've got a positive development of late. And that positive development is higher export commodity prices. Combined with last year's lower oil prices, that's given our terms of trade a tremendous boost. And this is significant. One can see from this chart, you're going back to 2003. The blue lines is the actual monthly trade balance data. So let's follow the black line, which shows the trend. And one can see how remarkable that upward shift has been. So the way that this is working is that an improvement in the terms of trade, increased commodity prices, that's an improvement in income. We don't need to do anything. We don't need to produce anything more. It's just an increase in income for a given level of production. And one can see here that it is substantial in our case. So people would argue, well, you know, mining is only a small component of GDP. So, you know, what's the positive impact? Well, the positive impact is that because this is an increase in income reflected on the balance of payments, and because wages is a fairly consistently large portion of total income in the economy, it permeates through to households and the positive effect therefore goes through to consumption spending as well and the GDP level more broadly. Another place where this has shown up as a significant positive is on the fiscal accounts. Now, we know that we have a significant fiscal problem in South Africa. So to be clear, we are still in trouble. We still have a problem, and we've still got a lot of work to do to get out of it. But relative to previous expectations, I think that we're in a patch now, partly because of the strong bounce in the terms of trade, where the data is looking better than expected. So if we look at the revenue collection year to date, which is what's being shown on this chart, the black bars, they show the first 9 months of the current fiscal year. So that runs from April last year to December last year, relative to the blue bars, which is the expectation for the full fiscal year, which runs through to the end of March this year. So one can see that the Treasury was expecting quite substantial declines relative to what we're actually seeing for the first 9 months. Yes, the data is still down, but let's put this into perspective. So when we got to the medium-term budget policy statement last year, relative to what the Treasury had expected in February 2020 when it read the initial budget, it was saying, and we all agreed, many of us at the same ballpark number, that was that there would be an under collection on revenue of about 300 billion rand, just over 300 billion rand. Indications are at the moment that up to December last year, there's been an upside surprise, collecting 80 billion rand more than would have been expected for that stage of the fiscal year. And this has been spread across a number of income categories, company income tax, personal income tax, and VAT. Together, they make up the bulk of revenue that the government earns. And the reason for this is that terms of trade impact, that positive impact of those rising export commodity prices is being reflected in the GDP deflator, the inflation component of GDP. And so GDP in nominal terms is now expected to only contract by around 4% this year, as expected, relative to what the expectation of the Treasury, for example, was in the medium-term budget policy statement of minus 5.6. The other thing that's happening is that the tax take relative to a level of GDP is better than expected. Because of all the uncertainty last year, what we generally worked with was a tax take similar to what we saw during the global financial crisis. So, and quite a sharp decline from around 26.1% the year before to around to about 3.5% lower in the current fiscal year. Sorry, from 26.1 the fiscal year before, 3.5% lower in the current fiscal year. But that 3.5% seems too aggressive, and it seems like the decline is only going to be something like 1.9%. So overall, we're probably going to get a significantly higher tax take per level of GDP than previously expected. Now, if you extrapolate for the full year, this would imply to our minds around about 100 billion rand better tax take than expected. So instead of the minus just over 300 billion, we're looking at just over 200 billion rand. It's not clear how much of that the Treasury would show. The first quarter data could be weaker again. There could be VAT refunds. So it's not exactly clear how much the Treasury would show. But let's just, for example, say that the Treasury were to take this benefit, sort of save this windfall, as it were, not adjust its expenditure numbers going forward, then the deficit would drop next year to 8.9% of GDP from 12.5% this year. And that 12.5% this year compares to the medium-term budget policy statement estimate for the year 14.6. So that 100 billion, 2% of GDP better off. So if you don't raise those spending numbers next year, you could get significantly lower budget deficit. At the same time, though, one has to be realistic, and that is that it's a long way back towards the pre-pandemic income level, and the long-term debt dynamics are still challenging. But for now, let's take the positive, that terms of trade bounce, along with the fact that it's reasonable to expect that we'll get less restrictions this year relative to last year. And given the fact that there's a weakening between the restrictions that get imposed when we have these COVID-19 waves and the level of economic activity, and given this very weak base that we're coming off last year, it's reasonable to expect GDP to bounce significantly in 2021. So we've got, around about plus 3.5% to 4%, depending on the strength of the terms of trade and how long it lasts. So we've got a bounce of 3.5% to 4% real GDP this year. Yes, one can say electricity outages, one can say third waves could impact negatively on that. So forecasts are open to adjustment, but it's still reasonable to expect that bounce. As I say, though, longer term, there's a lot of work to be done to get back to the pre-pandemic level. And so what that means is that even though the debt ratio might stabilize in the coming fiscal year at around 80% of GDP, the long-term debt dynamics, because we're not growing this economy fast enough, still unfortunately kick in. So it's a bit difficult to judge the near-term data. As I said, we're not sure how much of that 100 billion the Treasury would show. And also, of course, there are a lot of expenditure demands. So it may spend money, for example, on additional social grants. It may spend money on vaccines. But nonetheless, even taking that into account, one would expect somewhat of a, the picture is better than what one had expected for this year. Longer term, though, think about it this way. If we look at long-term debt dynamics, the important factors to look at are how much real interest you're paying on your debt relative to how fast your economy is growing, and then taking into account the primary budget balance. Now, the primary budget balance is revenue less non-interest spending. And so the sum one can do is to look at the difference between the real interest rate on your debt. So at the moment, the Treasury's real interest rate on its debt is quite low, and that's because it's issued previous debt at lower interest rates, and because it's issued quite a bit of short-term debt, which of course it can't do indefinitely. So it's relatively low at the moment, but over time, as they issue more and more debt at higher interest rates, that real interest rate is going to rise. So let's say it goes to 3% real for this exercise. Let's say trend GDP is only 1%. So 3% minus 1% gives you 2%. If you take that and multiply it by the debt ratio, currently around 80% of GDP, that gives you a number of plus 1.6. So close to 2% is what you require your primary budget balance surplus to be to stabilize the debt ratio. At the moment, if we're looking at the fiscal year ahead, even if we keep the expenditure numbers unchanged, even if we let this benefit that we've seen flow through and have a main budget deficit of minus 8.9 in the coming fiscal year, it'll correspond to a primary budget deficit of minus 3.8. You've still got to swing that minus 3.8 to plus 1.6, or let's call it 2%. Over the medium term to stabilize the debt ratio. And that's a lot of work to do against the background of an economy with such a high unemployment rate. But one last point I'd like to make that is important, and you're probably going to hear more about in the weeks ahead, is that government is sitting on quite a lot more cash than previously expected. So what happened here was that in the beginning of the fiscal year, government had about 263 billion rand in cash. It was expecting to use part of that cash to fund its deficit in the current fiscal year and run it down to around about 205 billion rand. The January numbers, however, show us that the government is sitting on 378 billion rand of cash. So a significantly higher level of cash than what had been expected. Part of that is the better than expected revenue collection. Part of it is that there's been a fairly high level of issuance. And one also has to bear in mind that government needs quite a lot of cash because it has foreign currency commitments in terms of debt. Last year, it had indicated that it was leaving $7.5 billion at the central bank and that it had committed to that. So that could have increased in the interim. So that's a significant amount of money. Also, it needs to hold cash on hand for volatility in expenditure and monthly cash flow. But even after accounting for that, it's sitting on a significant amount of cash, and it could use that to help lower issuance in the year ahead, which is a significant positive. Of course, there are lots of other reasons why it may want to hold additional cash. We don't know. For example, SOCs that require additional bailouts, and for example, the road accident fund, a lot of contingent liabilities that it needs to bear in mind. But the bottom line is, relative at least to previous expectations, the numbers are looking better. Unfortunately, though, these long-term debt dynamics still going in the wrong direction. So just to finish off about what risks we would face other than fiscal policy or related to fiscal policy, a lot of that depends on where the global economy is going. So firstly, last year, we had a significant turnaround in bond investors from abroad in South Africa. They sold bonds fairly aggressively during the first wave of the pandemic, and one can see here the blue line, how aggressively that declined. And at the same time, we knew that the SARB and banks had to take up quite a lot of government stock, which they can't do indefinitely, to obviously help fund the government at the time. And also we had to get that IMF loan to stabilize the balance of payments position at that point. So all of this illustrated how important foreign capital inflows are. If we are going to grow the economy in the year ahead, as we expect, we're talking 3.5% to 4% growth. We are going to be running a current account deficit, in my view, and to do that, you need foreign capital inflows to cover that. So foreign capital inflows continuing, which means we have to continue with economic reform to raise the potential returns in South Africa and to lower the risks of investing here. So the other risk, of course, would be related to the terms of trade bounce. We'd like that to continue for a while, and that will to a significant extent depend on the ability of the global economy to keep growing. We think that it will do that. There's a number of reasons. One is we've talked about the weakening link between restrictions and economic activity, and you do expect less restrictions in the coming year. Vaccines are a very important component of that. Additional US fiscal stimulus is coming. And also last year, the income transfers in Europe and in the US resulted in a sharp increase in savings, and so amongst households, and that there could be additional cash there for consumption spending. So a number of reasons adding up as to why we think that the global economy would continue to grow. But the other risk, of course, would be any change in global financial conditions, and that would be related to those foreign capital inflows that we chatted about a couple of slides ago. And related to the real interest rate story is what's happening in terms of fiscal policy. So to stabilize things last year, we know that governments spent a lot of money, and it wasn't just additional spending and revenue declining because of the decline in GDP. It was also equity injections, loans to companies, guarantees on debt. And one can see from this slide here, very high percentages of GDP being spent. At the same time, central banks expanding their balance sheets aggressively, helping to fund those governments. The light blue bars here are the central banks of the developed markets, which we've come to expect. But interestingly, a significant change in the last year or so has been central banks in emerging markets also joining in. The SARB still very conservative here, but significantly more amongst some of the other central banks. So what one has ended up with is ordinarily a jump in fiscal policy or fiscal spending to the extent that we've seen. Could often be associated historically with rising real interest rates, but not so this time. It has still obviously been associated with a strong increase in the debt level, and this is going to be a feature of economies for a number of years, is sitting with these high debt levels. At the end of the day, if you're not growing fast enough and you don't want to default, then the only way to make the fiscal maths work out is to keep the real interest rate low when you've got debt levels this high. I mean, the last time we saw this was during the Second World War. And for that reason, you've had those central banks stepping in, anchoring the short end of the yield curve, buying bonds, and obviously that helps to anchor long-term interest rates as well. And one can see here that US 10-year Treasury yield since 1915, historically low levels. And what that has done is it's translated into governments' interest bill relative to GDP remaining well contained despite that very high debt level. So this combination of fiscal spending and support by central bank balance sheets has kept interest rates low and helped this fiscal maths to work out. So clearly there are a couple of risks here. And one of those is that central banks also want inflation back in the system. Now, the Fed has been partially successful. We've seen inflation expectations in the US rise significantly since they were low during the first wave of COVID-19. And it would also suggest potentially, not anytime soon, I would think, but at some point you would start talking about if we start seeing some pickup in inflation in the system, or we start, importantly, the global economy recovery does become entrenched as we expect, you'd expect central banks to start talking about tapering these balance sheets. It's possible even that nominal interest rates begin to rise at some point. The important thing to bear in mind, though, is real interest rates, which are a function of expected inflation. So if we get some inflation in the system, remember central banks have got this very strong incentive to keep the interest cost low. And so one needs to focus on the real interest rate. If nominal interest rates don't rise as much or don't rise more than inflation does over time, then real interest rates remain low. Will inflation go up? Just one point to make there. I think in the near term, because of base effects, similar thing in South Africa, soft commodity prices are up, oil prices, and the weak base of the low base of last year probably means in the first half of the year we'll get higher inflation in the first 6 months of the year. But viewed over a year and running into next year, we've still got significant negative output gaps, and normally that's a powerful disinflationary force. In the longer term, the medium to long term, though, one needs to look at the potential for inflation and more inflation in the system, and that's related to fiscal policy. If we look through history, the worst inflation episodes was when we had bad times and unsustainable fiscal policies. So these are risks that we would need to watch for and obviously manage, but at least for now, we are in a positive patch, helped by our terms of trade. It's made the fiscal numbers look a little bit better in the near term. Doesn't mean the numbers look good. They're still deep deficits. The long-term debt dynamics are still in the wrong direction, but it's a bit of respite. At the same time, though, there are these latent risks that we also need to keep monitoring and managing. Thank you.
Thank you very much, Arthur. Good afternoon, ladies and gentlemen. From my side, a warm welcome to all of you. I think we've lived through an extremely eventful 6 months or so since we've last spoken. So if I can just quickly go through the agenda, what I would like to do is just quickly take you through the investment performance, and I'm going to talk investment performance to the end of January, because those are the latest numbers that we have available. And I'm going to deal with the local performance and offshore performance. I'm going to hand over to Peter to deal with global equities. And then I would like to talk about South African equities. As Carl mentioned, still 50% of the assets that we manage are still locally managed. And therefore, it's important that we do have a view and provide that view for those clients who are exposed to the asset class. And then I think it would just be appropriate to wrap up with our multi-asset views and how we play those views or manage those views into the multi-asset portfolios. So if you look at investment performance, I think there was undoubtedly during last year perception that the performance was under pressure. And of course it was. But I think when we look at performance, there are probably three ways that you should look at it when you analyze investment performance. The first one is, how does the nominal or the actual performance look? The actual number, is it 6%, is it 10%, 15%? And I think what you normally find is that, of course, naturally when the number is lower, clients do get a bit upset. But there are other ways that you should measure whether the portfolio manager or the asset manager is doing well. The one is over time, the longer term performance. Does it outperform inflation? We talk about the real returns. And then thirdly, and very importantly, how does this particular manager compare against peers in the market? So what I've done, I firstly look at the SPW equity model portfolio. So that is not an actual portfolio. So when your private portfolio manager manage your portfolio, it can deviate a bit. But this gives you a very fair indication, more or less, where performance should sit. And we also run a unit trust, and the performance of the unit trust doesn't deviate a lot from this. But nevertheless, I think very importantly is that you should look at the range of returns that was generated by the industry for the 12-month period to the end of January. Now, if you look at this particular bar, and this is the 1 year or the 12-month picture, you will see that the best performing portfolio manager generated a return of 26%. The worst performing manager generated a return of minus 20%. So the range, 46%, and that's absolutely unheard of. And it tells you something about the market that we've experienced last year. Firstly, incredibly volatile, and secondly, a massive disparity in the performance of the various counters that make up the investment universe when you talk about South African equities. When you look at the Sanlam Private Wealth model portfolio performance, that has been reflected by this little blue button. And the return that we've generated to the end of January after we subtracted cost is 13.3%. Now, many of you have noted the performance to the end of December because it's a calendar year, and I think we generated a return of about 5%. So 1 month made a massive difference. The performance, we dropped a weak month last year, January, and we gained a very strong month this year, January, when the performance was up by about 5%. And within 1 month, you've seen a massive move in the performance, as I said, 13.3%. If you look at how did we compare against competitors, the median competitor generated a return of 8%. So we outperformed the average in the market by 5 percentage points over the 12 months. So in our terms, we would say that we are quite proud with that outcome. I think the 13.3% should also, after the 5% in December, should be a welcome relief to many of our clients. And then lastly, if you look at this bar, you will see that there are 4 shades of gray, not 50. Those are just the 4 what we call quartiles, and you will see that the blue dot sits in the top quartile. And in short, it just means that we've outperformed about 80% of the competitors in the industry. If you look at 5 and 10 years, and we always argue that we would like to have the opportunity to run portfolios for the longer term because we take longer term investment decisions, the scales look different. And I think this is a disappointment for many of our clients. If you look at the median return over 5 years, we're talking 5%. And that is a disappointingly low number, but again, it's an indication that South African equities didn't really perform over the last 5 years. If you look at our own number, we've generated a return of 7%, which again is significantly higher over a 5-year period per annum relative to the competitors. And then very importantly, the 10-year number, which generated a return of 10.2%. And if you take inflation of, let's say 4.5% over that 10-year period, maybe 5%, that is a real return of 5% per annum, which we think is certainly a very, very good return. And again, significantly outperforming the median over that 10-year period. So in short, I think the process has worked quite well. It didn't come without concerns, but that was just the nature of the market. So that is the SA equity model portfolio. And as I said, I think the one characteristic that certainly stood out last year was the massive disparity in returns that you got from the underlying building blocks. All I did on this slide is I took the top 5 performers of the top 40 index, and I also compared it with the returns of the bottom 5 performers of the top 40 index. And you can see the top performing share was Process. It generated a return of 53% versus Redefine that lost 56% of its value over the 12-month period to the end of January. Now, the interesting thing is if you look at the numbers in blue, we had 4% in Process and 19% in Naspers. So you had 2 of the big winners in your portfolios, and the average exposure that we had carried in your portfolios was roughly about 23%, depending on the individual. The other winners that we had in the portfolio, Anglo-American, we had an average exposure of 7.2%. Unfortunately, we had 2 losers, and I will come back to those. One of the 2 losers, we had Sasol in the portfolio, on average about 2.6%. That lost 56% of its value, and we had Old Mutual in the portfolio, 3.9%. But we did not own any Nedbanks, we did not own any Growth Points, and we did not own any Redefines. If we look at the balanced portfolios, or what we call the multi-asset portfolios, that is where clients tell us you can invest in all the different asset classes, and they are so-called Regulation 28 compliant, which means they are appropriate for retirement fund money, where we can take up to 30% offshore. Our performance for the 1 year is in line with the average, over 5 years is in line with the average, and over 10 years, we outperform about 80% of the competitors. If you look at the nominal performance, again, they were quite modest, but I think over 1 year and over 5 years, but again, it was to some extent a function of the market, but we would certainly like to get that average performance over 1 year, get that up, and we'll talk about that later in the presentation. It is very important that we do focus on the global performance as well, and in this case, the Sanlam Global High Quality Fund. Many of you are exposed to the fund, and if you're not exposed to the fund, you might have a segregated offering that Peter and his team manages in the UK. Now, we started the fund back in February 2014, and if you look at this particular row, that would indicate what was the calendar year returns from 2014 right through to the end of 2020. Then we compare it with the benchmark, and the benchmark is the MSCI index, which is that row, and then we finally compare it with the peer group, In other words, if you had a choice to invest with the average global asset manager, what would your return would have been? Now, the interesting thing is if you look at 2014, 2015, 2016, 17, and 18, the team outperformed not only the benchmark, the MSCI index, but they've also outperformed the peers quite significantly for many of those years. It was really in 2019 and 2020. 2019, the fund did 23.5% in dollar terms, but it underperformed the MSCI index and it underperformed competitors. And 2020, it underperformed again both the index and competitors. Now, quite often when clients look at this and say, well, what happened here? Did we suddenly turn into a bad portfolio manager? I don't think that is the answer. What is true, though, is that we've had very extreme market circumstances where investment sentiment certainly favored companies with very good stories, and Peter will take you through that. So we had very unique market circumstances. We apply a particular philosophy. And the important thing is if you look at the performance since inception, is that this fund has generated return not compounded of 90.5% to the end of December. And if you compare it with the index, 82.9%, so we outperformed by 7.6%, and we've outperformed the average competitor over this particular period quite significantly. And as Peter said yesterday, and I thought it was just well said, since inception, this fund has returned on a compound basis 9.6%. Inflation was about 2% over this period. So in dollar terms, if you invested from since inception, you would have returned or received a real return of 7.6% per annum, which is remarkable. And if you offered that to us at the beginning of 2014, we would certainly have accepted that. So with that as an introduction to Peter, Peter, you can take those two red columns and then you can explain to clients and hopefully provide them comfort in terms of the philosophy and the actions that you take to address exactly that. Thank you.
Thank you very much, Alwyn. If you and welcome from my side. I see there's 590 people. That's very, very impressive. Thank you for your time today. And thank you very much, Alwyn, for just highlighting the return numbers. It's very, very interesting as we approach new highs in the strategy as we speak, and as the markets themselves approach new highs. It's very interesting, and this is as of today. And I just want to start off straight away with some performance numbers. Over 1 year, 9%. Over 3 years, 9.3% per annum. And interesting enough, it really surprised me. I mean, the market's up 15.5% per annum in US dollars over 5 years. We are up 13.5%. And then since inception, the fund is up 10.3% compound in US dollars over the full sort of 7 year, just shy of 7 year number. So I think if I just look at the nominal returns, very happy with that. I think 8 years ago, I did say that a high quality portfolio, if it's attractively valued, can give you 8 to 12% pre-fees. So I think that's pretty much worked out well for us. And that 9% number, 9 to 10% number is actually quite relevant across the board. Now, why have we struggled to keep up with the market just over the last 2 years? And I have a slide here for you. Let me just put this up for you now. What this slide is showing is that it is the number of shares measured by percentage, what is actually beating the market. So we have some extremes. I mean, for those of you who lived through the, was it called the Nifty 50s or the Nifty 70s? I think it was a Nifty 50 because it was 50 stocks driving the market. You can see there, if I put my cursor down there, back then it was IBM and Coca-Cola and the old Philip Morris back then who drove the market to highs, and only a few names participated in outsized gains. We saw that again in 2000 for a brief moment. Cisco was a $500 billion business, and a lot of investors thought that Cisco will take over the world. That didn't happen, and if you didn't own Cisco, you would be struggling to outperform. And this year was also the same. But I do want to reassure you, when you look at the narrow market, and I will show you in an attribution what it cost us not having Apple and Amazon and Tesla in the portfolio. But the reality is that when you look at just three companies, the three I've mentioned there for you, they were 5% of the 16% return of the market. So a third of the return from the market of 2,800 names came from three stocks. And that's fine. And I have to explain to you why we don't own it, because we are, of course, valuation focused. We are high quality investors. Two of those three businesses we define as high quality. We think Tesla is a fantastic total addressable market opportunity, but they don't necessarily fit the bill for us as a quality business. Lower margins, high capital intensity, but certainly Apple and Amazon are the businesses we want to own. And I've done a breakdown on Amazon today on a model I've been working on for a while. And we certainly want to own those businesses, but at the right price. So even though the market's been driven by a few narrow stocks, I do want to assure you that we also had our fair shares of great performers. And if you look at 2020, you can see there the headline, we are 6% below the benchmark. There are two ways to look at it. We might not have had enough winners, or we owned losers, or we didn't have some of the stocks that performed really well. So let me start with the bad news. In terms of the bottom performers, we, as I said, that 2.6 Apple, the way you should read it is if the market did 16% last year, 15.9, then 2.6%, or roughly 15% of the market's total return came from Apple. If you add Apple, Amazon, and Tesla together, as I said, it's over a third of the market's return. You can see Tesla, it's not a printing error, it is 743%. But that doesn't tell you anything about the value of Tesla. So I think it is Warren Buffett who said that Wall Street is a place where people know the price of everything and the value of nothing. And I think we are trying to obviously value our businesses. Samsung, as our top performer, all of that performance came through for us roughly from May last year. Coming out of a pandemic, you probably would have argued that buying a semiconductor business is not the wisest thing in the world. But it turned out to be 100% return stock for us over the 3 years that we held it. Very, very cheap, attractively priced business with a good return on equity, which was the same for Facebook, the same for Alphabet, and the same for Microsoft. And I want to assure you that we didn't get on the bandwagon for these names in the short term. We've owned many of these names like Microsoft for over a decade. So if we do have problems in the portfolio which hold us back, we will own up to that. Sabre, obviously a black swan event for us as a travel software related business, and Bayer Corporation held back by some litigation, but they've certainly started to perform much better for us, and Sabre's already doubled from extreme lows back in October. So we were better served to hold on to that business, not panic out of it in October. And why do we think that a business like Alphabet and Facebook is still worth owning? I looked at a competitor today, and it was very, very interesting for me. He or she owns both Facebook and Anthem as top 10s. And why do I mention these two names in particular? Because for us, a quality investment obviously has to be valuable as well. And we can own high growth businesses like Alphabet and Facebook if the valuation over time don't go too high. And what you see here with Alphabet is as a classic example of a stock that's done 300% for us, because the stock's moving up, but the earnings are growing with that move in the stock price. You end up with this sort of perfect chart where the valuation never seems to expand. Now, there has been an expansion over the last few months, the first time ever that Alphabet's moved out of its range. It did have a fantastic result announcement last week, and our intrinsic value is slightly below where it is today, but it's a good example of how we will buy into a business like Facebook. If I move my cursor here, we got involved here on the mid-July of 18 when the stock was on 16 times forward earnings. It's on some basis the same valuation today, even though the stock's moved from $130 at the end of December 18 to about $270 today. And we added to our positions at $260 just the other day. If we look at our portfolio activity, I'm very happy that we haven't been too active, we haven't been overactive. I have included in this slide only our outright purchases and outright sales. And if I take you through, I've taken it chronologically, how the year progressed. And if you look at what we first did is we obviously identified high quality businesses to invest in. And Accenture was a good example of a secular grower exposed to digitalization. We picked that stock up at very attractive levels, but what bowled us over and where we missed out a little bit was that the market's valuation kept expanding. So when we exited both Accenture and Heineken at levels 30% higher than where we bought, we didn't think the stock would get more expensive. Now we've had some news flow from names like Heineken, and I sent an update to my colleagues in South Africa today. We're seeing some severe earnings cuts coming through for Heineken because the lockdown, of course, is going on longer than market participants are expecting. And Heineken is a good example of a business where we just felt by the end of November, when the vaccine news came out, that a lot of the good news has been priced into that market. And we started seeing other opportunities in names like AbbVie, trading at 12% free cash flow yield, Electronic Arts, 6% free cash flow yield, Anthem, 8% free cash flow yield, and names like Alibaba, that came under scrutiny with the failed IPO of their Ant Financial. So we're constantly looking for those ideas. On the sell side, Heineken, a good example that I'll explain later for you, where we've suddenly found an opportunity to exit some of these severely depressed names back in March and invest in even higher quality businesses like Novartis, Electronic Arts, and Anthem, and they've done relatively well for us. This year, Alibaba is a great performer for us so far this year, up 14%. Then looking at how we think about buy and hold, here's some good examples of over the course of the fund. It's almost just about 7 years now. So you can see there, very high, very respectable, well-run businesses. Alvin will show you later on a slide on his side, just warning though that coming back to what Buffett said about value and price. And Microsoft, I was obviously, a lot of you know me, we've talked about MasterCard and Microsoft a lot. Now Microsoft is more expensive than 8 years ago by a factor of 2 to 2.5, but the earnings growth has come through. And that's why we've sold along the way names like MasterCard, Moody's Corporation, and Yum China. And in a market where valuations consistently been expanding, you look back and you look quite stupid because they say, well, it fits your bill. It's a great business. Why did you sell it? But I think, and I hope that valuation will matter again, and we can get into these names, including Samsung, at more attractive levels. So there's our top holdings. I would just highlight some of the new names in there: Alibaba, Novartis, and Becton Dickinson as 3 new ideas that we've included. I'm very hopeful that our exposure to healthcare will work well over time. I have a slide where I will demonstrate to you that the healthcare sector in the US is at a 30% discount to the market overall, which is very attractive by historical standards. Very shortly, Becton Dickinson, well, the top medical equipment businesses, over 80% of their business model is consumable. So these are very big repeat businesses with hospitals and other medical institutions. A name like Novartis have a very deep pipeline of new drugs, and Alibaba had excellent results again this week or last week, and our analyst Louis commented on that. So we're very pleased with how the portfolio is looking at the moment. A name like Anthem is trading on 11 times earnings and has some short-term headwinds for subscriptions to their health insurance business, but that's all COVID-related, COVID-19 related. We think those pressures will ease. So just on healthcare, what this orange chart is showing you just plots the discount of the S&P healthcare index against the wider market. So you can see there, the last time this happened was in February 09, February 10. I'm not sure if that was perhaps a transition away from the Republicans to the Democrats again. I can't honestly tell you why it got so depressed back then. But what I do know is that when we look at the sector overall, we're very excited by the high free cash flow yield that's on offer on some of these businesses. And I have to highlight again a name like Johnson & Johnson. If you look back, whether it's in dollars or in rands, this stock's compounding at double digits over long periods of time, and they become significant outperformers because they continue to deliver in a sensible way those free cash flows that we're looking for. So this is just to explain to you why we've been a little bit more active than normal in the portfolio. This chart again shows the relevant premium that Heineken traded against Electronic Arts. And we're only doing it because we sold Heineken on the 9th of November when the vaccine news came out, and we invested in Electronic Arts the same day, maybe the Friday before on the 6th. And you can see how suddenly the market repriced any sort of recovery name like Heineken, whereas a subscription-based model or a more stable secular grower like Electronic Arts with their mobile gaming exposure and their gaming business model was suddenly out of favor, and it gave us an opportunity. Now, Heineken, we returned 35%. The stock's already pulled back 10%. I think there's more to go. And Electronic Arts, we up about 20%. So it's worked out very, very well in the short term, and that's the sort of compounding effect we'd like to see from our portfolio as they compete for capital. And then Alibaba, you can just see there, if you plot Alibaba both against its own history, valuation-wise, against other names like Amazon that's doing the same thing. We think that Alibaba's obviously got a long runway for growth. There was an article that you might have seen in LinkedIn from my colleague Louis today, where he explains their ability to still attract new users, to penetrate underpenetrated markets in smaller cities within China. And of course, they are pure play on the largest population in the world, being the Chinese. So their results were very impressive. They have $50 billion of cash on the balance sheet. There are concerns around competition from some irrational players, but we hope that they can squeeze out those irrational players over time. And should they find the ability to list in an initial public offering their stake in Ant Financial, again, it could be good news for the stock. So we think we've increased our position in the low 220s at attractive valuations. Only time will tell if we are correct. And then I'm just going to finish again with our sell discipline. I'm using Samsung there now. Do note that price to book and price to sales ratios are not necessarily valuation tools that we believe in, but it does illustrate the point that, as someone once said, the most dangerous words in investment is that it's different this time. And I guess we're going to get a question perhaps on Bitcoin later, because that's just, it's one of those things, it looks different, it looks unique. It looks too good to be true. So when we look at valuations and we say to ourselves, it is a two-horse race now between Taiwan Semiconductor and Samsung. It is a very sort of rationalized industry now with a lot of competitors not there anymore, and therefore your returns are better. The reality is a lot of good news has been priced into Samsung. So we've exited that position and we've decided to invest our capital elsewhere. So in conclusion, just very shortly, the strategy is unchanged. Our philosophy of trying to find great businesses whilst not overpaying remains intact. We are obviously very, very disappointed that we had one or two of our names going through severe difficulties. It has held us back. However, I'm very, very happy about the 10.3% compound return over 7 years. I honestly didn't think that the market would be this strong. And it's strong because valuations are quite expensive in some parts of the market. And we just feel that, we are mindful not to overpay for quality. We believe our stocks trade on 6% free cash flow yield. It's very much in line with our history. So we have rotated the portfolio into high quality equities with an average return on equity of 27% at acceptable valuations of 15.5 times earnings. So I do hope that you will continue to enjoy the journey with me. I'd love to see you all in person again pretty soon. So I can't wait for this vaccine news to improve our lives. And I'm looking forward to your questions and answers afterwards. Thank you.
Thank you, Peter. Ladies and gentlemen, as I said, I would like to start with SA equities. Maybe the best way is just to share our view that we had throughout 2020 with you over a period that was extremely volatile for South African shares. In very short, last year, this time, we thought, or particularly after the sell-off in February, we thought that the South African market was cheap, but the story associated with South Africa and shares that operated in South Africa was certainly nasty. In other words, the outlook wasn't great. And many commentators over that period argued that the story was so bad that it wasn't even worth trying to generate investment returns in a market where there were so many perceived headwinds. I think it is true to say that the story hasn't really changed a lot, but I think Arthur highlighted one or two things that turned from headwinds into tailwinds. So that is the first thing. The second thing is, what we've also seen is that valuation, as Peter mentioned, is very important and remains very important in our process. And in fact, it's probably the biggest discipline that we buy into when we make investment decisions. And sometimes because you buy into that discipline, it does mean that you are contrarian. Nevertheless, what we've seen is that some of those shares that we bought initially didn't do a lot, but then recovered quite nicely. So I would just quickly like to take you through last year and share with you what we've done, because unlike in a unit trust portfolio, you can monitor each and every action that we've taken in your portfolios. So this is more or less what should have happened in your portfolios. Again, I would highlight that your circumstances might be different from person to person, and the portfolio manager's got a bit of freedom around these things. If I look back, I must say, in terms of timing, I will certainly not claim that we were clever when we bought a lot of shares on the 18th of March 2020. That was just about 2 or 3 days before the market bottomed and then started to recover. So the blue line is just a reflection of where the all share index traded. And then I've summarized the most important transactions that we've executed during 2020. So you can see on the 18th of March, we bought shares as a percentage of client portfolios of about 6%. The one that, the biggest of the lot was Anglo's, that we added at a price of 232 Rand. I think today it traded at about 536 or 540 thereabouts. So you can see immense recovery in Anglo's, and it was the biggest trade at the bottom. We added Bidcorp at 200 Rand, we added Bidvest at 161, and we added Netcare at 15. We sold Remgro because the Netcare and the Bidvest was partly a switch from Remgro into Netcare and Bidvest, where we thought that those companies show better prospective returns than Remgro, which looked to us a bit stale at the time. Nevertheless, so we added 6%. Where did we get the money from? There was cash in the portfolios because we had a slightly conservative position at the beginning of the year because we thought the market was quite elevated. As the market recovered, we added another 4% on the 14th of April. We added ABSA, we added MTN, and we added more mutuals to the portfolio, and we trimmed a bit of British American tobacco at the price of 670, more or less. So in about a month's time, we spent about 10% of cash in the portfolio, and there wasn't much cash left because we used the weakness. As the market recovered and some prices really moved very strongly, we could take some profits on some of those shares because the performance or the initial response was so aggressive that it was quite possible to take some money off the table. So we sold Prosus at 155. Remember, as I showed on my very first slide, that in the portfolios, we carried a weight of 22% in the combination of Prosus and Naspers. So we had to manage the single stock risk in the portfolio as well. Those shares held up very nicely. Some of the Bidcorps that we bought at 200 Rand, we sold at 85 Rand more. And of course, Anglo's almost doubled. And we took, as I said, we bought 3% and we sold about 1.5% of the higher price. And we added a bit of Northern for the equity portfolios at the time. And then, towards the end of the year, we added but to Investec at 33 Rand. It's trading around about 40 at the moment. And British American Tobacco, after it pulled back, remember we sold it at 667, it pulled back to our minds very attractive levels. We added to British American Tobacco, and again we reduced cash. So over the year, on a net basis, we reduced cash by about 11%. Now, of course, it must have helped performance because we bought it at times when the market was under pressure. I want to come back to what I said, the discipline and the philosophy. Just understand the pressure that we were under when the market started to fall and nobody really knew how COVID-19 would play out and what the impact would be on businesses. So we just said that we also don't know how it's going to play out, but the valuations of these shares would suggest that company earnings would be under pressure for quite a substantial length of time, and the South African economy in particular in this case will really suffer for a sustained period. We think that was overdone, and looking back now, about 7 or 8 months later, you can see that I think we've done quite well. Having said that, not all the decisions that we've taken were great decisions, and not all the holdings that we held in the portfolio did well over this particular period. And the one share that caused us a lot of pain and sometimes embarrassment was a share called Sasol that I've highlighted on the third slide. Now, this is the share price of Sasol. I show the share price starting in September 2019. It went up from about 250 Rand to just over 300 Rand and close. And then, as you can see, the share price started to fall. If I can get my mouse to work, started to fall. Then we had the pandemic and the share price fell from 200 Rand to almost 20 Rand. And then started to recover, and at the moment it trades around about 200 Rand again. So clients now quite rightly say, you had the share, it underperformed. You obviously made some wrong assumptions in the way that why you've included it in the portfolio, but apart from that, why didn't you buy the share when the thing was trading at 20 or 40 Rand in this particular area here in March, April last year? And I would like to explain that to you, and hopefully you will understand the reasons. The first point to make is that Sasol is a capital-intensive business. Now, a capital-intensive business, what is very important for capital-intensive businesses is that you need a strong balance sheet or cash flow. And if that balance sheet comes under pressure, and you're not exactly sure what is going to happen with the most important product that you sell, you can understand that the risk associated with that company becomes immense. And in this case, it really was serious, because what has happened is Sasol was in breach of some of their covenants. The balance sheet was under pressure, and the oil price at some point went into negative territory. Now, if the oil price goes into negative territory or remain low for a sustained period, when your balance sheet is under pressure and you're capital intensive, then a couple of things can happen. Well, the worst that can happen, you can go bankrupt. The second thing is you need to go to the market and come with a rights issue, and that will dilute shareholders. Or the third thing that can happen is you are forced to sell assets at a very reduced price at exactly the wrong time. So those outcomes at the time when you can't forecast the oil price within the COVID environment, increase the risk associated with the company. And we just felt that because the outcome can be binary, that we did not want to add more risk to the portfolio. Where we stand now, and I think it was one of the questions, should we still hold on to Sasol? Where we stand now, as a result of the oil price that has recovered significantly, the profitability of the company has increased. They've already sold off some assets. This company is now de-risked. And we're quite happy. We have an overweight position of about 1.8% relative to the benchmark. We're quite happy to sit with that. Should the price come under pressure from these levels, we will consider to add more. With the benefit of hindsight, we could have taken the risk at much lower prices to add to the portfolio, but it could easily have gone the other way. And we certainly are not speculators, and we didn't want to speculate on a binary outcome with a particular share on behalf of you. It's always easy to, afterwards to look at the negative things, but I think it's also just I think provides balance and perspective when you look at how we dealt with Anglo American. The first thing that I always say to clients is, remember, we're long-term investors, so we would like to buy shares that have got great assets and that will hopefully outperform over the longer term. Now, remember, when we talk about mining shares, they're always cyclical, but even cyclical shares over time can go up. Now, maybe I should take you back to the last time when commodity prices were really under pressure. That was back in January 2016, and the Anglo share price went down to 60 Rand a share. And many of Peter's, not colleagues, his peers in London thought that Anglos would go bankrupt. We had quite a significant holding. The share went up to 127. We added. The share went up. We took some profits. We took profits again. And then when the share price dropped to 232, we simply said that this was irrational or represented irrational behavior of investors, and we added 3% to the portfolio. Remember, we had about 6% at the time, so we added 50% to the holdings in the portfolio, and we trimmed less than half of that at these higher prices. At the moment, Anglos trades, as I said, round about between 500 and 550. At spot prices for commodities, the value of the share is north of 1,000. When we use our long-term assumptions for commodities, which is what we use to value these mining shares, there's still some runway left, and the value is just north of about 500 Rand, just on 600 Rand. But at the moment, there's significant support for these companies, and we're quite happy with the holding of about between 7 and 8% in portfolios. So that is just a bit of background on it. I think the big holding in Naspers and Tencent deserves a comment. As all of you know, the most significant asset within the Naspers and Prosus stable is their 32% holding that they have in Tencent. So the price of Naspers and Prosus has been dictated by the performance of Tencent. And Tencent has done remarkably well over the last 12 months. But as a result of that, the rating of the shares also gone up. So all I've done is I've just given you the forward price earnings multiple of the share. So the higher the number, the more expensive the share is relative to its earnings. And you can see it's starting to move into expensive territory. It was more expensive in 2018, it was more expensive in 2014, and it certainly was more expensive in 2007. So at least what we can say is we're moving out of green light zone into orange light zone. So we've got to be more circumspect in the way that we position the portfolios. The story and the business case for Tencent is still intact. The one thing, or the one reason why we haven't sold Naspers or Prosus in a material way in the portfolios is because there is a significant discount of the actual price to the net asset value of Naspers and Prosus. In the case of Naspers, you can see that the share trades at a 53% discount to its net asset value. And in the case of Prosus, because it's listed in Europe, the discount is not as pronounced as the discount that we see in Naspers. On average, the discount sits at about 47%. If that discount, for whatever reason, and management has indicated that they would like to get that discount down, that should still add a lot of value to this particular share. And to some extent, or to a large extent, it compensates for the higher valuation of Tencent. So we still like the share. We know that the prospective returns might be slightly less attractive compared to what we've experienced in the past, given the current rating of Tencent, but there's still enough on offer for us to maintain it in the portfolio. So I want to summarize on SA equities. I think if you do an evaluation of the market, it is still what I would call a two-tiered market. The so-called rand hedges, with the exception of British American Tobacco, are generally trading at higher valuations than the shares that make their profits in South Africa. So if Arthur is right in his expectations that we are going to see a decent recovery in economic activity in the second quarter, for the reasons that he's explained, we think that some of the earnings that these South African companies will make, that they might surprise on the upside. The valuations certainly haven't baked that in, and therefore we remain overweight in our multi-asset portfolios to this particular asset class. And we still think that the prospective returns in rand terms for this asset class over the next 12 months look quite attractive and might well be in double-digit numbers. So if I can move on to our multi-asset views, just one or two comments that I would like to make. Firstly, and it's looking backwards, but you can see if you look at the emerging markets and global developed markets, the blue and the black line, we've had a significant decline in prices. And since then, you can only describe the trend in these two lines that we've experienced a bull market. In other words, a market where prices in these assets that are listed in these markets went up significantly. Now, if the prices have gone up, if you didn't have a clue of what was happening in the world as we live in it today, you would say that this picture would indicate that we live in a world where there's a lot of prosperity. The fact is, although it was short, we had one of the biggest recessions since the Second World War, but this doesn't really reflect it. So I think just from a top-down perspective, it feels to us as if there's a disconnect between the prices of the so-called indices or markets and actual reality. So we need to investigate that. And the one, you get very, very strong views, both for people who are very optimistic about the market and people who are pessimistic about the market. And maybe it's just good to revisit some of those arguments, and you can put yourself into one of those camps. Of course, we need to do it because we need to run your money. The bulls, or the so-called positive investors, they argue that interest rates are very low and there's very little signs that it will go up. Because interest rates are low and central banks have created a lot of money with their policy measures, there's a lot of liquidity around. And individuals and companies and institutions use that liquidity to buy financial assets, and that drives the prices of financial assets. There's very little indication that any of the major central banks are going to take their foot off the pedal. So the stimulus measures in all likelihood will continue. Then finally, you can see that, as Arthur indicated, that economic recovery is still there. On the negative side, people think that low interest rates, gives you a false sense of security. The liquidity, when it dries up, markets will go the other way. And remember, growth comes at a price. So when you look at the valuation of US equities in particular, it does look elevated at a rating of about 22.5 times. But I think, if I may, Carl, and I know we're running out of time, but I just want to share one or two pictures before I close off. I think one must be careful not to become too negative on global equity markets, because global equity indices are inflated by the constituents, the heavyweight constituents in those indices. And I just use the US market, the S&P 500, to indicate that. These are the top 10 shares in the US market, Apple straight through to Visa. You can see the percentages in those companies, but then you can see the phenomenal returns that these companies had over the last 12 months. Apple up 82%, Microsoft 43%, Amazon 76%, Tesla 743%, so that makes us all look very stupid. But then you can see there were a few laggards. The point is, if you look at the column on the far right, you will see that most of these high-flying counters, they trade at very elevated price earnings multiples. 33, 33, 73, in the case of Tesla, 192. The average of the index is 22.5 times, which means if you go drop one layer below these high-flying companies, it is still possible for stock pickers to pick decent assets at levels lower than what we associate with these average price earnings multiples. So be careful of being too negative when you look at the market. What are the alternatives? Well, you can buy a government bond. You can buy a US government bond, and you can, if you invest in a US government bond today and you hold it for 10 years, your return in dollar terms will be 1.12%. So you can say, well, I can do that, or I can buy a share where I can get a dividend yield of 3, 4, 5%, and hopefully that dividend yield can grow. And in the case of British American Tobacco, by the way, that dividend yield sits at about 7.8% in pound terms. The growth of that dividend yield or dividend is probably another story. So ladies and gentlemen, I would like to conclude. When we put portfolios together for clients today, we still overweight equities with the bias when we have SA and overseas equities in the mandate with the bias towards South African equities. But it's a marginal underweight position in global equities. For clients in the Regulation 28 portfolios where we are not at the 30% level, we will endeavor to take that with the stronger currency at the moment. We will endeavor to take that position up to 30%, but we will be cautious in the way that we will implement that money in overseas portfolios. We don't really like fixed interest overseas. As I said, those yields are still too low. They normally are these things are normally uncorrelated with equity performance, so you should have some of it in the portfolio. But there are alternative investments that we can engage in to mitigate the risks and still get a return, hopefully better than cash and certainly better than these yields over the longer term. So still challenging times. I don't think that the macro world is de-risked. And I know that some of these assets look expensive, but for stock pickers, there's still enough, I think, to keep us busy and to build a portfolio where we can generate decent risk-adjusted returns for our clients. So, Carl, with that as a summary, I'm going to pass over to you. Thank you very much.
Thank you very much, Alwyn and Arthur and Peter. So we have roughly about 10 minutes left. So and we got probably more than 20, 25 questions. And I think some of those questions were very stock specific, were answered during the presentation. So what I'm going to try and do is maybe keep the questions a little bit more to industry specific. So I'm going to ask Alwyn a question on commodities. Alwyn, I'm going to ask you a question on the property sector, whether we think our exposure and our views on the property sector. Peter, I'm going to ask you a question on a little bit of emerging markets in China. If the developed market is a little bit high, what is our exposure there? And do you think we should increase our exposures there? And then Arthur, I'm going to ask you a question about the rand. So maybe if I can start with you, Arthur, just your view. So obviously the rand has strengthened quite a bit over the last couple of weeks. And what is your view on the rand going forward? And how should we and our clients think about the rand?
Yeah, Carl, so on the currency, in our opinion, it's always best to try and take a long-term view. There are too many influences in the short term that drive the currency away from its fair value. Now, over the long term, what we do is, I know most people's eyes glaze over when I use the word PPP, but in some currencies, it actually does seem to work over the long term, and the dollar rand is one of them. One must obviously not try and work off a base year, because to choose a base year, that's an equilibrium year. It's very difficult to determine. What we do is a best fit model. And over time, that does tend to track the rand. It makes sense. If your inflation rate's higher than your main trading partner in your small open economy, or one of your trading partners, over time, you're probably going to find that your currency is going to depreciate in line with that inflation differential. So if you'll notice, I don't have a chart to show, but if you go look at the movement of the rand over time, it has very sharp periods of weakness and then long, very sharp periods of appreciation. They vary by a couple of years in length, but they are big moves. And very typically, once you get past a period of very sharp depreciation in the currency, something usually happens. And that thing that normally happens is that the Reserve Bank steps in, raises short-term interest rates, because what it's doing is it's keeping inflation expectations low. So in the long term, if long-term inflation expectations are well anchored, then you'll expect the currency to shift back towards that PPP line. That didn't happen this time around because the bank, of course, was cutting interest rates. But remember, in April, May last year, the rand was heavily undervalued, very sharp move weaker. But at the same time, what we did do was we did get that IMF loan, and that stability that it produced on the balance of payments helped the currency to appreciate. And also, of course, the long term was still anchored. Inflation expectations in South Africa were coming down. And there's continued faith in the Reserve Bank to hold that long-term inflation rate at a reasonably low level. So you get these blowouts in the currency. That long-term inflation expectation being anchored is what pulls the rand back. And at the moment, it's trading, at 1460. It's not that far off. It's what we would consider fair value on that basis, which is around about 14. So in our mind, the big move has been done. And from here over the long term, you'd look for that inflation differential again. So the exciting move has been done, and we tend to only, my last comment would be, we tend to only look at the currency and would take a significant position if we're convinced that it is far overvalued or undervalued. So just that as well. So essentially that's the way we're viewing it.
Thank you, Arthur. So Peter, if I can move to you for a question, just in terms of one of the questions was, what's our view on China and Asia and the recovery there? And would you consider that? I'm pretty sure a lot of your companies have exposure there, they're trading there, so I think you see some of that upside there, but maybe just your view on diversification into Asia and China specific.
Yeah, so we've always taken the view, Carl, that we want to get exposure to the consumer side in Asia, simply because you get great businesses like Yum China, where the return on capital is high. They've got $1 billion of cash on the balance sheet. You're playing towards a secular growth theme and disposable income. So if you want to be selective, we are going to leave it to the experts to buy into emerging market banks, for instance, although we do think the Indian banks are quite well run. So to give you an example of a name we've been looking at called HCL Technologies. They Indian listed the competitor to Cognizant and Accenture. So these are businesses and industries we know very well. I've had a call with the CFO. So we will and can perhaps go directly into these emerging market names because you tend to find a business like HCL actually operate globally as well. And they've got great aspirations in places like Canada and Europe. But we do get most of our exposure through our consumer staple related names. Reckitt's obviously big exposure in Asia with the Mead Johnson acquisition. Unilever's always been very well positioned in India. And then our pure plays in Tencent and Alibaba, they are pure play e-commerce and mobile gaming and cloud computing related businesses that are not necessarily cheap, the way that a deep value investor would want to see the valuations, but where we think a quality investment like that at a decent free cash flow yield is worth owning. So we are going to get our short-term exposure through Alibaba. We will be active though. So Samsung was in there for 3 years. We made 100% in that name. We'd love to own Taiwan Semiconductor. It's too expensive for us. So we're looking at these big global gorillas and we'll get our exposure that way, but we're probably quite careful of places like Turkey, Brazil, etc. We can't stomach that sort of currency behavior we're seeing there.
Thank you, Peter. And then Alwyn, if I can finish with you, because I think we've got 4 minutes left. I know you've prepared for this one, so we get this question a lot, and specifically what happened with the last couple of weeks. Just why don't we have exposure to cryptocurrencies or for example, like Bitcoin in our model portfolios? And then the second question, if you can, and I know you probably have Dave who may help you, one of our analysts there in the office, to help you with that answer. And then just while Dave talks about it, if you can just, one of the questions that always come up, well, what about other alternatives? What about new economies? What about green type of investments? And I know through our investment strategies in the UK, the Real Asset Fund, and Mike Mongera, one of our portfolio managers there's quite a number of investments in green energies, wind farm, music rights, those things. So just 2 questions. One, if you could just finish off with a view on cryptocurrency, then just a little bit of our view in terms of alternative type of new economies and alternative companies coming through in our investment philosophy.
Yeah, I think maybe I should start with the second one. There's no doubt that you've got to look at alternative investments as well, particularly in a private client portfolio. And in our multi-asset portfolios, one of the solutions that we've embraced was the real assets funds, as you said, and significant exposure of the real assets funds is into renewable energy. So the team who make those decisions are people who are equipped to do the analysis on those assets and then bring them in at the right price. Locally, we can also tap into the work of the private equity in SIM, where they often get proposals in that regard, and then we can include it in those portfolios. Just on cryptocurrency, and I see Dave is moving in here, but I would just like to make one point, and I'll leave the rest to Dave. It was interesting. We had a session yesterday when an intermediary said if you don't have a cryptocurrency in a client portfolio, the intermediary needs to be fired. Robini wrote a piece overnight, and he said, if you have cryptocurrency in a private client portfolio, you need to be fired. So I think the answer probably lies somewhere in between. But my view on it is, and the reason why we haven't really gone into it, to my mind, we just find it very difficult to put a value on an asset when an asset doesn't produce an income stream. So that is the first thing. So how do you value it? So you can only hold it because you think another person would be willing to buy it for whatever reason. So that is the first thing. So if you can't put a net worth or worth on the asset, then to my mind, or in our view, you speculate on it. And Dave can give you a bit of, he's made an effort to try and put a value on it. So then you speculate. Then the last thing on speculation is if you can put a value on it. If I take clients back to early in 2017, Bitcoin was trading at $1,000 per Bitcoin. The end of that year, Bitcoin was trading at almost 20,000, if not 20,000. For a year later to trade at 3,000 again, and then just move sideways before now, you get this whole frenzy again. So, if that is not speculation, nobody could tell you then why they paid a particular price for it, except that they thought it would go up. And maybe I should pass to Dave, because I have this discussion with my wife during breakfast as well. And she's very annoyed about the fact that we haven't got Bitcoins in our portfolio. But I'm very happy to have that discussion with her again.
Good evening, everyone. Maybe just to add a few comments to what Alwyn said. Any asset or theoretical asset that doesn't generate cash flows is just about impossible to value. If you own a bond, you get the interest and you get the capital back at the end. If you own equities, you're going to get dividends over time. If you own Bitcoin for 100 years and never sell it, you'll get a grand total of zero. So you just have to wait for somebody else who's willing to buy it at a different price to you. There are ways you can think about valuing it. Maybe you think, because you essentially mine Bitcoins with computers. So if you look at it similar to a commodity, right now it costs you about $7,000 to mine a Bitcoin, and the price is at about somewhere in the mid 40s. So sort of 6 to 7 times the cost of manufacture. So, certainly if you looked at gold, you'd say it's very expensive relative to cost of production. You can, if you stretch a lot of assumptions, get to the current value for current price for Bitcoin. That's if you assume that maybe one day global asset allocation portfolios accept this and decide that you should have around about 1% in your portfolio. Under that scenario, you'd say all the different cryptocurrencies in the world should be worth somewhere around $1.5 trillion, which, if you work it back, comes to about $60,000 a Bitcoin. Maybe call that in 5 years' time worth somewhere around 40,000 today. But I make a lot of assumptions just to get to the current price. And of course, it might just be exactly the same as tulip mania in Holland back in the 1700s, where those assets actually had more utility because at least they made a pretty flower. It's not a great answer, unfortunately, but the truth is that the only way you're going to make money out of Bitcoin is if you find someone else who's willing to pay an even higher price than you.
Okay. Thank you, Dave. So again, just from my side, from Carl, Head of Sanlam Private Wealth, and Alwyn, Peter, and Arthur, thank you very much for your time. Thank you for joining us this afternoon. And thank you very much for your business. And we look forward to our next webinar with you in another couple of months' time. Thank you very much. Take care.